How to trade during earnings season. We're picking up for this Q4 of 2024, entering into our top tech earnings right before an election. And whether you're watching this in the future or you're watching at the time of this recording in 2024, is still applicable to you. Welcome to the channel, everyone. I want to dive deep, but short and sweet in this video for you to understand how to properly invest and trade during earnings so you can stay liquid, stay profitable, maximize those gains, and manage your risk. Right? This is a prime opportunity to make a lot of money during this season, but also a lot of folks just don't understand fully the implications of earnings and how they work. So they end up fumbling the bag during earnings season, especially trading options. All right. So let's jump into it today. But really quick, my name is Dr. B. I'm a holistic life and business coach and strategist for entrepreneurs and thought leaders. I'm also an investor and options trader, been an entrepreneur for the past 8 years, former pharmacist, undergrad in chemistry, and I matriculated my way up into this point, right, full time, and been teaching and educating and coaching these thought leaders and entrepreneurs on how they can be financially literate and also, understand business and life a little bit more, create a life of freedom for themselves, whether you decide to start a business or not, right? You're in corporate world, but you want to have a skill set that you can generate income anytime, any place, from anywhere. All right. And you control the outcomes. With that being said, let's jump into it right today. I'm going to use the example of Google in this earnings example today. All right. So Google is our first big tech earnings at the time of this recording. So let's jump into it. There's the options chain. But first, I want to dive deep, as I always do. If you haven't checked out my videos before, I like to use Notion, my Notion templates, and just really give you an outline, really like it's a class, and really wanting to, there's a lot of different types of learners on here, and people learn differently visually, but there's a lot of folks that want to take notes and really understand this. So I want to provide that to you. Let me delete that because we're from our last one, but how to trade during earnings season, R&D, research and development. Okay. So you need to understand the fundamental analysis of a company, right? Their balance sheet, the CEO, leadership, right? Really diving deep into what is this company anyways? What do they do? Because not every company is good for trading, more so on the option side during earnings. Some companies, you just want to see what they're doing to see if it's a good buy potentially in the future, or right now, if you want to hold their company shares. Okay. So I'd like to check out the balance sheet, if they're profitable, how's their cash flow, and I'll show you really quick how to do that. Their CEO, does their CEO a leader? Is he focused? Is she focused, right? Are they preparing for the future? Are they moving with the future? Or are they lagging still behind with old tactics and just not really listening to their shareholders? All right. Technical analysis. This is where the charts come in. So I'll show that on the charts. Is the company bullish going into earnings? Is it a little bit more bearish coming into earnings? Right. And it really doesn't matter either way, right? Because it's going next into the significance of the company. Do I trade it? Right. Because not every company that you'll see on this list is tradable, right? Not every company that you see right here is tradable for options necessarily. And I'll show you the reason why. All right. Calculating the expected move. Okay. This is important for some people that want to know, like, how much can this move either direction, either up or down? If I'm a shareholder, what should I expect the earnings to move in, whether it's positive, negative, or in between? Right. So there's a way that you can calculate how much the stock is going to move after it reports earnings. The earnings report. Right. A lot of folks have never checked out an earnings report or listened to an earnings call. So I think that's important too, to really understand how and why the company moves so drastically, like a recent Tesla. Why did it blow it out of the water and move up $60 post earnings, things of that nature, right? Why didn't it just move the expected move of maybe 20 to 30 bucks, right? It just kept going and kept going. So earnings per share is important. Did they beat on earnings per share? Are they growing in that realm? Revenue. Are they continuously profitable? Are they generating more revenue quarter after quarter, year after year? Guidance. What is the forward guidance? I'm a shareholder, right? Because I like to make these videos relevant for anyone and everyone that's listening on these public platforms. So I'm really thinking about the beginner or the intermediate person. And for my investors or savvy or more experienced traders and investors, you already know this is the piece that's very important. And a lot of folks don't understand is, how do they beat earnings and it drops, right? It could have been guidance, which is very important. What is the forward outlook of the company, right? Are they kind of soft on their AI and the development of it? Is it going to come out sooner than later, right? Are they have a new partnership that's coming sooner or later? Are they over promising, under delivering? Are they under delivering and then they overpromised and no one expected it, so they shoot up? All right. So that's what guidance is. And then obviously I said earnings call. Let's speed through this right here. So implied volatility, we'll go over that. Why you should trade post earnings typically. And a lot of people just, don't understand why I can't just throw in a contract, a call or a put and see what happens. And we'll go over why that may not be the best strategy. And then a strategy or just suggestions for you to consider, because I do not tell people, what to do and buying and holding and selling and what to trade, right? This is for educational purposes only. Please do your own due diligence, but we have had success with these strategies. The gold standard is trading post earnings. Okay. That means after the company has reported, then you can actually see how it settles in, what the guidance was, what the earnings per share, what the revenue were, and then you can trade it off of that. Now, earnings pre earnings, you can pick a side. And why we call it lottos, for those that think trading is gambling still, right? A lotto, we put in quotes, is because this is an educated guess or educated strategy over, maybe you've done a lot of due diligence on this company and you feel convicted that Google, in this example that we're going to give, is just going through the moon. Okay, put in a call, put your money where your mouth is, right? But anyone or an experienced investor typically does not do this, but if they're convicted, they are cool with the risk, right? So if the contract costs $200, right, and you put a $200 call in for Google, right, and you spend $200 on that contract, great, right? If it goes through the moon and you make $1,000 and you profit 800, awesome, right? You won. But also, hopefully, you're expecting that if it goes the opposite direction, I'm cool with losing $200. So the risk to reward is worth it for you, right? You do not want to put your whole account. You do not want to bet on these things going in one direction or the other just because you have an emotional connection to this company. All right. Pick a side. All right. Pick a side. That is one strategy. Okay. Call or put. Straddle or strangle is I would say a more advanced way of properly doing it. If you did want to put in a lotto, that means you're buying a call and a put at your specific strike price. Okay. You're picking a call and a put. So whichever direction it goes in, your hope, right, or your strategy should be that call, if it goes up, right, pick up the phone for my beginners. Again, if you have not watched any of my beginner videos, pick up the phone, call going up, put down the phone, meaning I can make money coming down. So I can buy a call and a put. If it goes up, great. My call wipes out my put option, right? Because I've generated so much more money on the call. Vice versa. If it goes down, I make money on the put. It wipes out the call. So that is how you stay profitable. But I'll show also with implied volatility why that might still not be a good strategy. Okay. So with all that being said, hopefully you can hit a like down below. If you hit a like really quick for me, that'd be amazing. If you hit I know some people have been commenting, that really does help as well. If these videos give you some value, like, hey, Brian, I really learned from this. Put a fire emoji. If there's any questions, put those down below in the comments as well. I'd love to hear them. I do read the comments as well. If you have any additional things to add on here that I missed, please add that too. I'd love to hear your perspective. All right. Let's jump into the R&D. Okay. How do you do research and development on a specific company? Okay. And let me make sure there's no videos playing on here or anything, because sometimes it acts up a little bit. All right. Perfect. So I'll go very quickly over this on this page. This is on Yahoo Finance. You can look it up on Google Finance, whatever your platform that you want to use. And you go into the company and you can click on their financials. Now, you want to see from most recent, I'm on an annual. You want to see this number, keeping it very simple. This number is going up, total revenue, right? And obviously Google, we know that Google is generating revenue every single day, every single minute, every single second, and is increasing in their revenue, right? So that's a given. Cost of revenue. The next thing I'll look at is I'll look at the profitability. So I'll go into where net income. Okay. Net income. So I want to go into this net income piece and I want to see that they're generating more profit. Okay. Net income. Okay. Not gross revenue. So I want to see that they're generating profitability. Okay. cool. They took a little bit of a hit in 2022, like most of the tech companies, obviously, but they bounced back pretty strong. And right now they're doing well again. So this looks good. You might click into quarterly, take a look at that as well, how they've been doing over quarters. Okay, they've been increasing slightly quarter to quarter. Okay. Revenue, kind of iffy here a little bit. I mean, it's been increasing that 2020, that Q3, which they actually, did pretty decent. Excuse me, which one? Okay, this first quarter. Okay, this one was their good quarter, right? This one was their good quarter. So they increased significantly from here. So we want to see this number right now higher than 84. Okay, so we shall see. Okay, so that's the first thing. The next thing that you typically look at is you look at a company's cash flow, and there's more in depth that you can go. This may be a separate video, but you just want to see that the company still has a lot of free cash flow. Okay, a lot of free cash flow on deck. All right, so that is the fundamentals of this particular company. And you may look at their CEO, how their CEO's vision is going, things of that nature. All right, so let me click off of this because it is slowing just a little bit, lagging just a little bit. All right, now let's come into our next piece, which are the technicals, okay, the technical analysis. So I want to come into the charts, and I want to click on Google. All right, and I want to start on a weekly time frame on Google, and I want to look and see how it's leading up into its earnings. So is Google forming a bullish nature, right? So I work from right to left, and I want to see that Google is forming higher lows here in a short time frame. So what do you consider a short time frame, Dr. B? Maybe back a month or so. Just in the recent month to 2 months, in the last quarter, is Google forming higher lows here on a trend? Yes, it is. Okay. Now you may consider this a bull flag, or it could break down and come lower and then bounce up. So we have lower supports down here in Google at the mid 140s to 150 range. And there are some gaps below, right? So do you see how that on a technical basis, you might think that Google's going to blow it out of the water, which I have some bullish nature on Google, but again, right, it's up in the air, right? Because it could go down and then rip back up, right? And just rotate very quickly. We've seen that before for my experienced investors. We've also seen things rip up and then rotate back down very quickly. Okay, because maybe their guidance was off or whatever, or the sentiment just wasn't right. Okay, so Google could go either way. It could go up here, right, like that, and it'll be a massive green candle, after hours on Tuesday at the time of this recording, Tuesday afternoon. Okay, or it will have a massive red candle that will be down like that. Okay, so either direction it could go, right? So when you have a little bit of indecision, right, in a top tech company, you want to just be a little bit more cautious, because I'll go into the next piece here, that they provide great opportunities to trade post earnings. Okay. All right. So there's the technical analysis, significant of company. Now let's go into calculating the expected move of an earnings move. Here is how you calculate how much it's going to go up or down in that range, right? If it kills the earnings, slight guidance, whatever it does, up or down. You select the first expiration date after the earnings, okay? So let me use Robinhood as an example, because I know a lot of my subscribers and followers and supporters use Robinhood. I personally use Webull, right, for majority of my trading, but I still use Robinhood as well, just because a lot of my community members use Robinhood and clients, all right? There's nothing wrong with it, especially coming out with a new Robinhood legend. That's a whole nother story, okay? So I select the in the money call option. So I select the most nearest date. So Google reports earnings tomorrow, October 29th, after hours. So I select this November 1st as the closest. I do buy call, and I want to do an option contract that is at the money. So as close as it is to where the share price is, so that's 167.5. So I'll pull up the calculator here. Okay. I want to do 5.6. Actually, before I do that, 5.6, and I want to take the put, and I want to do at the money put 6.2. So I got 5.6 plus 6.2. 5.6 plus 6.2 equals 11.8. Okay. Now you do 0.85 times 0.85, 85%. Okay. There is the expected move of Google up or down, $10. Okay. $10. Right. So if I go into Google, I can expect Google to be up at 177 or so, or I could be expected for it to be down at 157. So if I come on my chart, does that align potentially with where Google is now? Yeah, it looks very bullish right here because there's this long wick sitting on the 20 moving average, and it's kind of broken out of this consolidation triangle pretty strong. So there may be a little sentiment, more so of bullishness with a lot of investors. So you can kind of see, like, leading up to that earnings, that are people buying it up, or are they kind of like fading and selling it down, right? It's just an assumption because we don't know. All right. So if I've calculated the expected move, there is how Google would react. Okay. That's about $10 from where it is, about 177. It would probably just move up to 180 maybe, just because it's a psychological round even number, right? So that is an expected move of Google. But if it does not, for whatever reason, it would come down and have a red candle down to about 157, and maybe it pushes even lower if it has weak earnings or weak guidance. Okay. So that gives you a lot of opportunity because you can see where it will go to expectedly post earnings, so you can be ready for that trade. You can already go ahead and mark that level off. All right. So if I come into my charts, I would probably mark off 170, just say 178 to be round. Right. And I see there's a little bit of resistance right there. All right. And I'll just mark off 180, the full gap fill right about there. Okay. So I can expect Google to maybe come into here potentially. Then I'd mark off maybe the bottom of this range here, about 150, 151. Like that. All right. So there's my expected move of Google up or down. Right. Hopefully that helps. Hit that like button. Hit that like button if that helped. If you've never heard that before, if you have, hit it as well, because you know that it's true. Okay. All right. Now, what if it kind of comes in soft, right? Or flat, right? And you're like, Brian, Google didn't move $10 either way. Yeah, that can happen. It can come in very flat, right? So where it just really doesn't move at all because there's a little bit of uncertainty either direction. Okay. So you can get a flat earnings, which is, not necessarily good either because you don't know which way it's really going. All right. So there's calculating expected move, earnings report. It has earnings per share. And all you really want to look for is, in my opinion, did it beat or miss? Okay. So what I typically do is just I look, and did they beat or they miss? And you can Google this. All right. All puns intended. You can Google it. You can look it up on, Twitter, and just type in the ticker symbol. And typically it will show you immediately. There'll be people that are already reporting it, or obviously you can go to the company's website and they'll have an earnings report ready to go. All right. Or Robinhood or your trading platform, they will already have their earnings ready to go. You can read the report. All right. All I want to know as more so a trader, because I'm intraday trading, I don't want to go too deep into the depths of the earnings. I'll typically read it afterwards. I just want to see the reaction, right? Now, if you're a long-term investor, which we should be in a lot of these companies, you want to know what the company's got coming forward. If they have a super strong earnings, it may give you more conviction to buy up more shares no matter where it is, right? And just keep dollar cost averaging because you know that they have an expected guidance and a forward outlook, right? So guidance, right? How is the guidance? Meaning, see, this is really when the earnings, I should probably put this like this, right? The earnings call. So how is the CEO talking up the company? Do they have new things coming? What's on the horizon? Do they have a expected release, a partnership, whatever it might be? So do they have forward guidance of continuously beating these earnings, or are they a little uncertain? And you'll typically hear that from the earnings call, and you can also read it slightly in the report. All right. So those are the three things that you're looking for. And if you have all three aligned, typically you'll have a bullish nature for a company, which is what every company wants on their earnings. if typically guidance is off, you can have a double beat and the stock comes down. It may pop up pre-market, but then it comes down, right? So there you go. Implied volatility. Let's speed this up because I said I would keep it short and sweet, but I also want to make it informative. If this is good, hit that like button. Implied volatility. This is the measure of how the market expects a stock price to fluctuate in the future. It's a key factor in determining the price of an options contract. Okay, so let me show you what that looks like, and let me do it on my Webull platform first. Let's keep Google. So this thing called implied volatility, you can have it. I'll show you what it looks like on Robinhood in just a second. So if I'm looking at these Google contracts, Google has earnings this week. Okay. At the time of this recording, it's coming out tomorrow after hours. So I'm looking at this implied volatility. And if you look back at this, when you have good priced options contracts, you don't want to go to an auction, or you don't want to show up at your favorite store and they've got all your favorite stuff elevated. You go to Target and you're like, why is this meat so high? Why is this, my normal chips or whatever, like, why are they so elevated? Because they're in demand, right? Supply and demand. So a good options contract, when it's in good supply, in good demand, it will typically be slightly less than 30%. Okay. Neutral means it's really in demand. There's a lot of hype on it, a big expected move that may be coming, earnings, whatever it is. There's just a lot of eyeballs on it. Then it becomes more in demand, right? Less supply. That means that it's typically around 40 to 60%. And then when you have elevated implied volatility above 80% into the 90s, that means that there's a big expected move. There's a lot of eyeballs. There's a lot of attention. And when you have that, the contract price is going to be elevated. So you see here that Google has roughly about an 80 to 70% implied volatility, not super high like a Tesla earnings, which was 100+%. Okay. That is when, in my opinion, you're expected a big move, but ultimately just wait till after earnings because it's a true gamble at that point. So 80 to 70%. And shout out to all those that won on Tesla earnings. I'm not saying anything. If you made a lot of money, great, but it could have easily gone the opposite direction. Just saying. All right. So 80%, 70%. That means that Google's contracts, if you know, this 170 contract on Google is not anywhere near $400 close to in the money for a call option, right? Google is about $4 away from this 170 call, and this call option is never for a weekly contract $400. Okay, it's typically around the $200, maximum $300 range on a Tuesday or Monday. Okay, maximum. Google's contracts are not that pricey. It trades very, very well, in my opinion. So you can already tell, maybe for my beginners, you don't know yet, but we already know that Google, I'm not spending $500 personally on a weekly contract on Google because I know that that is, very elevated, right? And that could depreciate very quickly once their earnings report. Okay. So what does that mean, Brian? If I come back again to our guide here, that means before earnings, the implied volatility tends to be elevated as traders buy more options than usual in anticipation for the announcement. Again, that demand goes up, right? So they're elevating that price. During earnings, the market reacts to the earnings release, causing the stock price to fluctuate, and that implied volatility starts to contract or crush or decrease or settle in. Okay. So that's why some of you, if you've ever traded earnings before, you're like, I picked a 170 Google call and it's at zero. Like, why is it not moving? Like, it should be going through the roof. I should be making 1,000%. It's because it went through that IV crush or IV contraction. All right. So after earnings, IV tends to drop quickly and significantly, which decreases that contract. So to be successful, and this goes into the final piece here, what I was saying earlier, to be successful with an earnings lotto, you need a tremendous move, right? You need a tremendous move for that contract to be severely in the money. All right. So let me give you an example. Again, using Google. So I'll come back to Robinhood for anyone that uses it, just so it looks familiar to some. And I come back to calls. All right. And just say I think Robinhood's going to, Google's going to do that expected move. Robinhood also has earnings this week. Google's going to do that expected move of $10. So I'm going to come all the way out here and like, man, Google's going to go to 177.5. And I select this contract, which is going to cost me $192, right? $192. And I select that and I spend it. And Google goes to 177. Great. This contract, if you don't sell that contract immediately and it pulls back and IV crush and contraction steps in, this contract could go all the way back down to $100, right? $115, $120. You may have a 5-minute window. Maybe it pushes a little bit higher. So for those of you that are beginning or have been through this before, if you've ever traded earnings, if you already know that that move has made your direction, you're like, man, I'm going to win in the morning. I'm going to take it out and I'm going to absolutely crush it. You don't want to wait on that unless you have multiple contracts that you can hold a runner, as we call it. So take that contract out. All right. Do not hold that being greedy. If you are in calls and it goes in your direction, you see this big, massive Hulk candle, you need to be waking up like, I need to get up out of this thing. Okay. Just look at the profit later. Okay. I'm just telling you right now. All right. That is the I would say the secondary, that lotto option that we were talking about. Now let's talk about the gold standard, because we want to make sure that people are learning the proper way. If you want to make this a true skill set in the future, I want to wait until, and it's hard to wait sometimes. I want to wait until earnings reports, because if Google pops up to 177 and this contract decreases, I can still trade it very successfully and more confidently, whether it goes down and pulls back heavily and I can get into puts, right? So if Google goes to 177 or 180, right? And I may want to look at a put option because everyone's going to be taking their profit potentially, and I want to play it back down. Great. Even if it goes up and I want to play a call, I can get these calls that are in the money right now. I can get a 175 for maybe less than $2, right? Less than $200. So now I can be confident that I'm spending less and getting more value post earnings. We good? That making sense for everybody? Hopefully so. All right. So I think that summarizes it for most people. The straddle and the strangle, we talked about that, right? That would be picking a call. So I would go up here and, this is the non-gold standard way. I would come up here and pick a 177.5 or a 175 to keep it in the money. And I would come into here and pick, a 157.5, and maybe they wash out, right? But final disclaimer, just to put a little bit of oomph in making sure you're doing it the correct way. This is not gold standard, right? This is not gold standard. Please do not go out and do this, blow your accounts, do whatever you do, thinking I'm going to make a bunch of money on earnings. You can, but make sure you're managing your risks. Make sure you're trading post earnings because of that IV crush, right? I know it's hard, but if you want to, great. We have people in the community. Once you understand how it's done, yeah, we might signal a lotto because it's worth it, right? Because if expected move is $20, $30, $40, yeah, a lotto call or a put option or a straddle or a strangle might be worth it. But if the expected move is $5, $7, $10, man, I might as well just wait till post earnings and just see how I can get a bigger move. So the Teslas, the Metas, maybe even a Microsoft, like those are big movers, $20, $30, $40, the Netflixes, $100. Like those might be worth it to put in an options lotto properly or a strangle or a straddle properly. All right. But with all that being said, I think I just want to make sure I cover everything here. I think so. All right. If I miss anything, right, let me know. But thank you guys and ladies so much for being on this platform, on this channel, for the support, for the push to keep pumping out these videos for you. There will also be my podcast videos and life coaching videos that will be attached to this in a separate section. So make sure you go check out my podcast as well. Link below if you want that mental and psychological shift in your life, right? If you need support on business or whatever it might be, if you want to become an entrepreneur, understand how to and market yourself and sell and all those things, amazing. But if this is the skill set you came for, hopefully you learned something. I'm sure you did. And if even if it was a reminder for you, great. Peace, love, and blessings to you. Trade safely during this earnings season. Make a bunch of money. Manage your risk. And I will see you all in the next one. Peace, love, and blessings.